Research consistently shows that financial advice is linked to better outcomes. What does that actually mean? Well, it means that insurance plans are more likely to pay out, investment returns are likely to be higher, and mortgage setups are more likely to save interest over the long term. Today's conversation centers around the role that mortgage advisors play in New Zealand. 60% or more of mortgages are arranged through regulated and licensed financial advisors. They claim to be the advocate, the expert, and the counterbalance to the power that the banks hold. Recently, some mortgage advisors claim that banks, who are potentially chasing higher short term profits, and regulators, who potentially are peddling solutions to problems that don't exist, might be unintentionally restricting access to the advice that can genuinely move the needle. Joining me to discuss is retired mortgage advisor David Hart and current mortgage advisor Jeff Royal. Hope you get a lot out of this conversation. It's a little bit niche, it's a little bit specific to this industry, but it demonstrates a much broader systemic issue that occurs. Will larger banks and more involved regulators stifle the very thing that can grow wealth in New Zealand, or will common sense prevail? Please be sure to check out the article in the show notes for this one, but let's get started. Mortgage advisors, their primary avenue of remuneration is commissions, which are often but not always linked to the loan amount. There's different models. Some advisors will charge upfront fees, myself included. If I'm providing mortgage advice, I don't accept commissions, but most people will be accepting commissions if they're mortgage advisors. But do you feel, David, that commissions, do you feel that that adversely affects the quality of the advice?
No, I don't. I think that the first instance, a mortgage advisor's main role is to get the loan approved. And with all the different variations that are around now, the amount of money we're going to get paid by getting the loan approved is irrelevant, really, because it's in the eyes of the client. They're not necessarily worried about what we're getting paid, although we do have to disclose to them what we are getting paid. But I don't think bank offering a higher commission rate will affect the quality of the advice that has been given by the mortgage broker.
Right. So an extension on that then is, do you feel like some mortgage advisors might favor the lenders that pay the highest commission? Because that is kind of like one of the biggest accusations out there, right?
Look, good advisors won't favour lenders based on commission payments. Good advisors will favour lenders that get loans approved in a timely manner. I think that's becoming more and more what our expectations as advisors are.
So Jeff, in your experience, but also just because I know that you work in a very specific part of the mortgage advice industry, but in your experience and in your observation, do you feel like banks, like the mainstream banks, like mortgage advisors? And I'm not referring to bankers, but banks as in the institution. Do they like mortgage advisors?
That's a really good question. I think just picking up on what David said about commissions, the Commerce Commission last year came out with this report, which sort of hammered our industry quite hard. And one of the big things was around commissions. And there's a bit of misinformation, I think, out there that on balance, banks pay around about the same. The model might be different, but the actual dollar value is pretty similar. So it's kind of a non-event. So as David said, the onus on the advisors to get the loan approved quickly, timely manner, does it fit, and all that kind of stuff. So that's the overriding sort of driver. Do banks like mortgage advisors? Well, I guess it depends on who you talk to. The reality is mortgage advisors account for over 60% of loans written in New Zealand. Because of that, I think the banks have to embrace the advisor community. I don't think they have a choice. And there will be people within the banks who embrace that. And there may be people in the banks that perhaps don't. But the reality is, as an industry, we're here to stay. 65% In New Zealand, it's running at just over 70% in Australia. In the UK, it's running at 80%.
Oh, wow.
And in the US, it's over 90%.
Wow.
So as a distribution, we are pretty strong. And I think for the right reasons. It's all about consumer choice, isn't it, at the end of the day? So a consumer can go directly to a bank. They can go online. They can use an app, or they can go to an advisor. It's their call. And if we weren't doing a good job, I don't think the level of business that we do would be as it.
Right. Consumers are being presented with the market in one go through a relationship with another person, an advisor. Do you feel like that increases or decreases the likelihood that banks will offer competitive interest rates?
Price is a factor, but it's not the overriding factor. So yes, a bank will come out. Yesterday, ANZ came out with a whole suite of, sub 5% products. Amazing. Will the other banks follow suit? Yeah, of course they will. So as an advisor, and we can't call ourselves independent, but we are independent of any lender. Our role is very much monitoring what's going on, as David said earlier. We watch what that bank, what that lender's doing, and all that kind of stuff, so that when we get the consumer in front of us asking for a particular scenario to be solved, we've got maybe a dozen different options to look at, and our role is to pick the best option for that client.
Sure.
Regardless of how we get remunerated, it's customer first, and not only is that a regulatory thing, it's just good business practice.
Yeah, there's a lot of baggage with that word commissions, and a lot of assumptions that are made based on some types of financial advice that was delivered in the past, which there were issues around that, legitimate issues. But I think there's a definite hangover that some types of people carry forward into an industry where it probably doesn't belong. But just so that we're really clear, if commissions were banned, if banks didn't pay mortgage advisors commissions to arrange home loans, do you think, and this is for either one of you, do you think that consumers would actually be willing to pay for the services of a mortgage advisor?
It's an interesting question there, Darcy. I think just about every industry we've seen move away from the commissions, the airlines, all that sort of stuff, and they're now moving into having to pay for the advice. Just like we have to pay for our solicitors, we have to pay for our accountants. I'm just sort of thinking that at some stage our industry will head down that track. And will the consumers pay for it? I think the consumers are quite happy to pay for very good, solid advice, correct advice. They're probably not happy about paying for anything substandard. So,
yeah, I think that's the key, isn't it? It's paying for the right advice, quality advice, and with commissions, yes, we are under a legal obligation to disclose what we earn. The debate on whether that's right or wrong is perhaps outside this conversation, but we do have to disclose. And we also have to disclose under what circumstances that commission may be taken back. So you get the thorny issue of clawbacks. And it was refreshing to see that ANZ, about a month ago now, cut their clawback period.
Can you just explain what the clawback means?
So the bank pays the advisor's fee for service. So advisors are not free. And it really annoys me when I see certain adverts, come to us, we're free. Well, if you're free, you have no value. So our fee for service is paid for by the product provider. So that's called a commission. And it does come with a slight sting in the tail that if a consumer repays the mortgage within a period of time, so the industry average at the moment is 27 months. And it's normally on a sliding scale. So what that means is if you take your loan with ASB, for example, through an advisor, and you repay that loan or refinance the loan in 12 months' time, the chances are ASB will take 100% of whatever they paid that advisor back. So that's called a clawback. And under the rules, the advisor, provided they've disclosed this to you in their documentation, is quite entitled to invoice the consumer, if they wish, up to a certain amount. In the industry at the moment is a maximum of $3,000. There is talk that might go up to $5,000. So commission is a lender's way of paying for the advisor's time. Clawback is if the commission is taken back, and that's normally the early repayment of a loan. That's how it works.
Great, thank you. So now just thinking also, Jeff, like over the last 9 months, I've been kind of watching this from more from the sidelines, but over the last 9 months in particular, the response times from banks for mortgage advisor applications has gone out from what used to take roughly 1 to 2 days to 2 weeks or even more sometimes. Meanwhile, the consumers who go direct to the bank can often get a turnaround within 24 hours.
Yeah.
And there's even some advertisements where the banks are taking advantage of that and actually promoting their speed over mortgage advisors.
Correct.
Do either one of you have a comment around whether or not that is good, bad, ethical, or otherwise?
Commerce Commission conference May last year, where had all the heads of banks in front of the Commerce Commission panel, and they were asked point blank, is there a policy of channel inequality in your bank?
So channel inequality means coming direct versus going through an advisor.
Correct.
Right.
And every single head of bank said no. Okay. So part of the advice process is if somebody's needs an urgent response and they might bank with Bank A, which might be the best bank for them, but we can't get an answer for 2 weeks. And Bank B, which is slightly inferior, but you can have the response in 48 hours. It depends on the client's need. That's why the value of the advisor is the independence. So we can say that bank, might be your best fit, but hey, you're going to wait forever to get an answer. As far as advertising, I have to be careful what I say. There are a couple of banks, one in particular, who seem not to be engaged with the advisor community. And they're advertising where they're saying to consumers, don't go to an advisor, come to us directly, and we will turn your application around in 48 hours. Now, if that isn't channel inequality, I don't know what is. To be fair to them, we're almost like the police. We've got eyes everywhere. And generally speaking, if an advisor sees an advertisement, and I can think of one with a bank this week, and we said to the bank, come on, this isn't playing the game. And to be fair, they pulled it. So they do listen. Going direct, that's fine. If a consumer goes direct, and in our business, I've actually told a couple of people to go direct. I can't help you.
Sometimes that's the best answer.
You come first. So if I go to your bank for you, awesome. I get paid for it, maybe, but I'm actually not acting in your best interests. So I know that you go direct, and here's the number. You will get your answer in 48 hours. Now, if the answer is no, then please come back to me, and I will find your solution elsewhere. So you just have to roll with it sometimes.
Got it. So sometimes the decision on which lender to recommend is a bit more nuanced than just here's the cheapest deal. But to make it easier through advisors requires a different skill set than it does if a consumer is coming direct. Have banks invested in technology or processes at the same rate, in either of your opinions, to make it easier to receive applications through mortgage advisors?
No. So the application process in Australia, bearing in mind that our banks are all owned by the Australian banks, or the majority of them are, they have a way more automated process of getting an application into the lenders than what we do here in New Zealand, and I just can't understand why that has not transferred across to us here in New Zealand as well. So the answer is no. I don't think they have.
No, and I think they're almost being forced. I mean, one of the ComCom recommendations, which I agree with, is almost forcing the banks into, I call it, into the 20th century, because at the moment I think most of them run on steam engines. The technology is there. It's not as if, as David said, in Australia, and the UK and the US, they use seamless technology. If you're an advisor in Australia and a consumer comes to you for a loan and you put it with X Bank, as an advisor, you can actually log in to the portal and track that loan right the way through to settlement. It's so if a consumer rings up and says, "Hi, can you tell me the status of my loan application?" Sure, it's instant. Here, it's phone call, which doesn't get answered, email, which you might get answered the next day. You leave a voicemail for a BDM, and I feel for the bank BDMs at the moment. There are some seriously nice people out there, and their backs are against the wall because they're being bombarded by people like me saying what's going on. And technology could actually solve a lot of that.
Yep, totally agree with all that, Jeff.
What's the theory then? Like, if considering there's 60% of business plus going through mortgage advisors, what's the theory behind why this lack of investment has occurred? Are mainstream banks here in New Zealand purposefully throttling the mortgage advisor distribution channel?
I just think they've all tried to cut costs and everything like that as far as they can, and unfortunately, we caught up in that.
I think certainly that was the case at the end of last year when obviously the impact of the U-turn by the Reserve Bank in terms of interest rate cuts that started in July and August, that caught everybody a bit by surprise. So the volume and it wasn't volumes of purchases, it was restructures, refinancing, all that started to grow. And I don't think any of the banks had replaced staff that had been lost by natural attrition in the previous 2 years. And let's not forget, the last 2 years in our industry has been pretty brutal. And so they were suddenly caught short. But you sometimes sit back and you think, well, why did it catch you by surprise? Why are we still doing things in a certain way? And what's happened to catching sensible decision making? I think this is where AI is going to be really interesting going forward.
Right. So if people's income relative to their debt that they're asking is really good, and it looks like they're relatively low risk of defaulting on their mortgage, then there's no reason why a computer algorithm or AI can't just go through that.
They've got minimal external debt. There's a lot of technology around trawling bank statements these days, so they can pick up, gambling habits and all that kind of stuff. If it's squeaky clean, there's no reason why there couldn't be an auto accept program.
And going back, David, this one's probably a good one for you. So if it's true that lenders are favoring one distribution channel over another in some way, as evidenced even just by the turnaround times, why is it that the advisors seem to be targeted by the Commerce Commission rather than the banks to this degree?
I think that the advisors will probably be an easier target, which is why they're probably looking hard at us, even though we've got a gazillion times more compliance than what we ever have had in this industry. I just sometimes wonder, to me it seems a little bit unfair that advisors are quite highly trained and skilled and have got compliance coming out our yazoo, whereas banks probably don't have the skill levels or the knowledge to give advice, yet they're doing it, and they probably don't have anywhere near the compliance that us as individual advisors are going through. It's almost like compliance has got out of control. It's like everybody's a drug dealer or bloody laundering money until we can prove they're not. That's the feeling we get at times. So.
And do you feel like there are, because banks, a lot of people would kind of look at banks as in same thing with power companies, same thing with supermarkets, where they go, oh, it's a monopoly. Well, technically it's not a monopoly because there's more than one player. It is what's been referred to as a stable oligopoly. And there's nothing illegal with that. That's perfectly allowable. And where it isn't allowable, though, is where they collude, where they are engaged
in a cartel.
Like a cartel, right? So as soon as they cross that line, then they're a cartel, and they're price fixing, and they're using strategies to increase their profitability at the expense of other people, often the consumer, ultimately the consumer.
Always
the consumer.
Yeah.
We haven't really seen evidence of cartel behavior, but we have seen evidence that there, at the very least, is silent collusion, where each bank obviously recognizes that it's in their joint best interest to act in a certain way with policy, with pricing, with procedures to extract maximum profit from their business activity. In either one of your opinions, do you believe the law needs to change with this respect, or do you think this is still totally appropriate?
I don't think it's that appropriate because, like you said before, when ANZ or whoever it was moved their rates yesterday, will the others follow? Hell yes, and they'll go quickly, and they'll all the rates will end up being within cooey of each other. Some minor little tweaking in that, so it's kind of like there's competition there, but is it really competition? It just seems that everybody follows suit pretty quickly, and that always raises question marks in my mind.
I think this was the linchpin of the Commerce Commission last year, when they're sort of, and I will use the word attack because it was an attack on our industry, and we fought back very hard, and we've had some not insignificant victories.
And that's a lot of that is credit to you, Jeff. So thank you for that. That's good.
Well, and amongst there's a lady advisor, Sarah Curtis up north, amazing advocate for our industry, and then you've got the professional bodies as well. So Lee at FAMS and Nick at Financial Advice New Zealand, and the aggregators. To a greater or lesser extent, there was a big fight back against some of the accusations made. The big thing, going back to price, and the Commerce Commission were absolutely adamant that as an advisor, you should only focus on price. And we just went, no, it doesn't work like that. And they kept talking about Australia and how it works over there. And there's just a lack of understanding. Australia might as well be on a different planet from a technology perspective and actually from a legal perspective. So in Australia, you're a mortgage broker. You actually hold a credit license. In New Zealand, we're mortgage advisors. It's a totally different regulatory framework. And they just didn't seem to grab that. But as David just said, ANZ come out with this amazing suite of rates yesterday. Other banks will follow. That's the free market. ANZ as a bank, or it had to be the biggest bank, they will make a move. And the other banks will look at that and they'll either move with it or they won't. And if they don't, and somebody is price driven, then ANZ will write more business. But if they make the criteria so tight that you might have this lovely carrot of a rate, but actually you can't borrow as much as you need to, then the bank that didn't match the rate but will lend more money, well, they will get the business. So it's all about this dynamic of free market. And I think the Commerce Commission got it wrong. There is a free market economy at work.
Well, let's delve into that Commerce Commission piece because, and for those that are listening or watching, what is the Commerce Commission, right? They enforce fair trading, consumer protection, and competition laws in New Zealand. They ensure markets work fairly for businesses and consumers. So that's what they do. That's what
kind of watchdog.
They're a watchdog, right?
Yeah.
The Commerce Commission chairman, John Small, who used to run a consulting firm over 17 years that worked in areas including financial services, wants mortgage advisors to present 3 different offers to each borrower, or he wanted that. And his belief would be that if mortgage advisors had to present 3 different offers, then that would increase the likelihood of consumers getting a better deal and it would increase competition.
Whoever thought of that, or where the hell that's come from, I don't know. That will just clog the system. Like we're talking about, we blew out to two weeks prior to Christmas for getting processing done and loan approvals done. If we was to have to go with 3 loan offers for every borrower, that'll be 6 months before we get anything done. That's just ludicrous, and it's just so far out of the real world that it's not funny. Everybody's costs will go through the roof.
Yeah, it's trying to fix a problem that doesn't exist. If we have to do this, as an advisor, is it a major? No, it's not. With the CRM systems we use, you can flick off an application to 3 different lenders in 10 minutes.
So it's not an issue if we don't want to do the work as an advisor. The issue is we don't want to make it harder on our business partners, the banks, who will get even slower because they can't even handle one application.
But also, I posed the question, who pays for this? So as an advisor, it takes me 10 minutes to fire off the same application to 3 different banks. So there's no cost, additional cost for my business. The banks, huge additional cost, knowing that 2 of the 3 applications they're processing will never go anywhere. So who's going to pay for that? We're not paying for it. Will the banks pay for it? I struggle with that one. So it's going to be the consumer. So at the end of the day, the consumer will be worse off for no benefit, because it goes back to, we have a free market economy working when it comes to pricing. By sending all these applications willy-nilly, it's actually to the detriment of the consumer. So you've got multiple credit searches for starters. And then if you're a first home buyer, and they're probably the most vulnerable in this, and you're borrowing more than 80% of the value of a property, then every bank is going to want a valuation. So to get to an unconditional loan offer, which is then priced, so pricing means they actually lock in an interest rate.
And they won't negotiate on an interest rate generally until
it's unconditional. They'll give you an indicative, but they won't lock in the interest rate until the loan's unconditional. So to get that loan to unconditional, you may need a registered valuation. Well, if you've got 3 different banks, you might need 3 different valuations. Who's going to pay for that?
So perversely, in an attempt to create better pricing, lower costs for consumers, this has actually, or this could, if it actually went through and people didn't stand up and say, hey, no, this doesn't make sense, this could actually increase the cost to the consumer.
Yeah, no, it won't. It's not maybe.
It will.
It will, because banks are like any business. You have your costs, and any business, you pass the cost on to the consumer.
Does the Commerce Commission understand this industry?
No. And I've been involved in the Commerce Commission a lot in the last 12 months, and it's very clear to me that they do not understand the industry. They didn't even understand that when you go for a pre-approval. So let's take Westpac, for example. So when you get a pre-approval from Westpac, all it says on the pre-approval is you can borrow $800,000. That's it. There'll be conditions on it. So there's no mention of interest rate. There's no mention of structure or anything of that nature. It's just a piece of paper that says you can borrow $800,000.
It's an offer of finance.
An offer of finance. There's no rate mentioned at all. They didn't even know that. So they have no understanding of how the system works. I'm not saying our system is perfect by any stretch of the imagination, but actually it works pretty well.
Okay. Let's now just talk a little bit more about the Commerce Commission, because when I was doing my research about this, I was reading about as broadly as I could. Like anybody, right? We all have biases. We can't be completely impartial with our personal views. And when we're a civil servant, though, the standards are a little bit different, right? You can't let that impartiality seep over into...
Shouldn't do.
No. And so we're not expecting perfection out of our civil servants, because if they're anything like us, we know that they're just not perfect people.
We're human beings.
We make mistakes, right?
Yeah.
Is there a risk, at the very least, that industry pressures could exist, which may influence the decisions of these regulators or semi-regulators within this industry?
Okay, I guess the answer is there could be. I think so. March 24, Commerce Commission came out with a draft report about the banking industry in New Zealand, and it was fairly comprehensive. Some people might say it was quite disruptive, and actually that's not a bad thing. Every so often, stuff needs a bit of a shake-up. Buried in that report, and this is where it became quite personal to our industry, buried in the report was a paragraph about mortgage advisors, and it was just plain wrong. So we were tarred with, we're basically money grabbing. We only go to people that pay the most commission. It was really bad. So as an industry and certain people in the industry, we fought back. We got an apology. And it was an apology that for what had been said. And I think it was because nobody at senior level had proofread the report before it was published. Because if they had, I don't think that paragraph would have survived. So the industry got an apology, but it also got a promise to engage with the industry. And to be fair to ComCom, they did do that, both at the conference last year, where there was a Q&A session, and we were invited to give views on multiple applications. Why is price not the overall driver for an application? And this is where we came up with the 4 Ps. So it's price, policy, procedure, and process. And depending on the customer, there will be a degree of change of the priority of those Ps. I'm pretty sure most of what we said at that time went over the head. But now we've learned that within the last couple of weeks that they've now had a reversal. So there is no requirement for 3 applications. And it's all a big misunderstanding. I'm struggling with that one.
In their words, I think they would be of the view that they never really made that a mandate. It was just a recommendation, a soft recommendation.
It was a pretty hard recommendation. Yeah. So I think there's been a lot of lobbying behind the scenes. And whether that was, well, I know it was from our industry, but also I can imagine the heads of the banks, having a crack as well, saying, come on, what you're doing is potentially tripling the costs of mortgage applications to no benefit. And I think the key thing here is there's no perceived benefit to the consumer. Okay. If there was, hey, I'm all for it, but there isn't.
Yeah.
Just coming back to that, where the ComCom decided that the price was the most important thing. This is the way they're going to drive competition. Pricing on all the surveys I've seen, pricing is coming in at about number 7 or number 8. That it's way down the ladder. Any broker that's just dealing in financing, providing options and solutions for their clients based on price alone is not going to survive for very long. There's way more to it than just the interest rate.
You'll get, in the nicest way, you call them rate shoppers, rate jumpers, whatever, and that's fine. There are people out there that purely go on interest rate. The person that comes out at the end of the day where they want to be is the person that engages with a professional. And it's not just our industry, it's multiple industries. And so loan structure in our industry is key. And there's no magic wand. If you want to pay your mortgage off early, you overpay. It's as simple as that.
Pay off more off the principal. That's how you save interest.
Yeah, every dollar you overpay on your loan comes off the principal sum. And there are companies out there that will charge you a fortune
just to tell you that.
So there you go. You get it from me for free. There is no magic wand. So structure is really important to killing your debt early.
So if we say then that Commerce Commission got it wrong here, they were targeting the wrong thing, and it's not in fact going to result in a more competitive banking environment from the consumer's perspective, what should they be focusing on instead?
Technology.
Okay.
And they have already made it very plain to all the players. You've got to invest in technology, and I don't really understand why New Zealand banks have sort of dragged the chain.
What's your theory on why they might have dragged the chain?
In Australia, I understand, and I'm not an expert, but I understand in Australia there are only 1 or 2 platforms that all the banks use. One of the things that Commerce Commission were coming out with very strongly was what's called open banking. So this is very much technology driven. And so open banking is where you make it easier for a consumer to switch provider. So in this case, banks. Interestingly, it's been in Australia for 2 years now. So they have open banking, and that's what the Commerce Commission want here in New Zealand. Since open banking became available in Australia, less than 1% of people have taken advantage of it. So fixing a problem that didn't exist, maybe. I've heard this before. People by and large are, and we're no different. We are creatures of habit. I bank personally with ASB. I'm quite happy with ASB. They provide me with a service. I've got no issues. Why would I suddenly want to change to Westpac or Kiwibank or where there isn't the need, generally speaking, for that kind of process to be put in place? And Australia would, to me, would sort of prove the point.
Okay. And I guess going back to the start, right? Like if financial advice is linked to better financial outcomes, better satisfaction with wealth, improved financial behaviors, and better returns. So in the context of mortgages, that would be a lower amount of interest that you pay over the long term because of the value of advice. Then obviously we should be upholding consumers' ability to choose. If they want to go direct to the bank, of course, that makes total sense. But I guess what I'm trying to draw out of you guys is, like, do you think that regulators and maybe even banks are inadvertently, let's say, getting in the way of the benefit that could be delivered to consumers because they're making it harder than it needs to be for everyday advisors to do their job?
I don't think there's a conscious,
of course not,
move. I think there are degrees of willingness, degrees of levels of investment,
incentives.
So I mean,
or lack of,
or lack of. I mean, it goes back to there is a bank that's probably got 65% of its business comes through the mortgage network, no advisor network, and there's another bank where it's probably sitting around 40. There are reasons for that. So they might be technical. There may be a culture in there. Does that particular bank who's around the 40% mark, are they sort of saying, well, actually, we don't want business through the advisor network? I mean, they seem to have made some interesting moves recently with downsizing their broker unit. They disestablished a couple of their BDMs, and they seem to be putting quite a lot of marketing into come to us directly. We'll turn it round fast.
It's the same lender that has previously done this and pulled out of the market completely.
Yes,
right. People can do their own research.
So this is it's at the end of the day, a bank is a product provider, and I'm not denigrating anything, but that's all they are. They are providing a product,
a financial product,
financial product, and there are probably 7 to 10 players in that sort of space. And then you've also got in the non-bank space, which happens to be my pond, there's probably another 15 or so players. So the consumer has got options and choices. And even if a consumer can't go to a bank, and this is where I see AI actually, I know some advisors are quite scared about AI. They feel that the consumer will be taken away from them, and to a certain extent, the cookie cutter, that may well happen. What I think may happen is that because it will be more cookie cutter, more people will fall out of that system and therefore play into our hands. And particularly when there might be a credit issue or somebody's self-employed and all this kind of stuff. And New Zealand is built as a nation on self-employment. And banks generally don't like self-employed people. I've never understood that, but they don't.
Yeah, that banks don't like self-employed people comment, Jeff. I totally agree with that. I always find it hard to believe that if I'm running a business and I've got 30 people working for me, for those people to get a loan, they just need to take in their pay slip for the last 3 weeks or whatever, and their loan will get approved. I'm the creator and I'm the one running all this. For me to get a loan, they want to see the last 3 years' financials and explain to them in depth and so on and so on. And you have to look at it and you think, what the hell's going on here? Yet somebody working for me can just walk and flip out a few pay slips and away we go. Biggest
One
relief.
of the questions which I've never had an answer to, and I have said this to many banks over many years, is, you know, if you're an employee, you're actually not in control of your destiny at all. You can be made redundant tomorrow. As a business owner, whether you're a plumber or it doesn't matter what you are in control to a greater extent. And there was really good research done in Australia a while ago. In New Zealand, we call it LODOC. So for those of you who don't know what that means, LODOC is low documentation. So if you're self-employed, you go to a bank, the bank wants 2 years financial accounts. They want everything. LODOC is generally either some bank statements and GST returns that shows money washing through your accounts, backed up with a letter from your accountant. Now, those loans you cannot get through a bank. A LODOC loan is not a bank product. But in Australia, did research with a lender called Resimac, who are really good in LODOC lending, and their interest rates are about 0.25% more than a bank. So more expensive, but marginal. The LODOC book in Australia outperforms most prime bank mortgage books.
In terms of arrears, so like falling behind?
Yeah,
okay.
It's a better performing book. And when you think about that, the mindset of somebody who's self-employed, you know, if the market goes a bit quiet, you work harder. If you're in construction and the two jobs over there have fallen over, you go looking for the jobs over. You keep going. The employee doesn't have that
ability.
Same.
They can work harder or not. It doesn't have an impact.
So I've never understood why banks, and it's not just New Zealand, but particularly New Zealand, have been so anti self-employed. They might say that's a bit strong, but
and that means that money is in the pockets of genuine economic growth engines. Like these are businesses that are scaling, hiring more people, creating greater economic output, paying more taxes. This is kind of where you want money to go.
Yeah, and I'll give you a really simple example. Was recently we had a phone call from somebody who runs a little cafe, and the coffee machine blew up. Pretty hard to run a cafe if you haven't got a coffee machine. And they'd only been in the country 18 months, and they did not own a property. So they went to their bank, and you know, they're pretty successful cafe till the machine blew up. And the bank said, no, we won't lend you any money. Okay. So they went to the coffee machine suppliers, who generally have some kind of lease deal going on. And because they'd only been in the country 18 months, sorry, won't lend to you. So they came to us, and we found them 15 grand in 24 hours from this company that specializes in this. And so they bought their coffee machine, and they're back up in business. That should have gone to their own bank. Should have done that.
Yeah, exactly.
Whatever interest rate they would charge on a business loan, even unsecured business loan, would be what, 9% maybe. Whereas his other company charged them something in the 20s. But again, interest rate doesn't come into it. Without that money, they couldn't run their business, and they've actually now paid the loan off.
There you go.
You know.
So either one of you want to comment around where the official cash rate might be at the end of the year? I know different economists will be kind of changing their forecast throughout the year. Started out being 3.25, now 3. Some are saying 2.75. I'd go much lower myself. Do either one of you want to comment on what the OCR, the official cash rate here in New Zealand, will be at the end of this year?
I'll put a box of decent red that says 3%.
3%. Okay.
Okay.
Not too aggressive.
No.
Okay.
And why do I say that? There's so much going on in the world, you know, and we're little old New Zealand. We're a speck of dust at the bottom of the South Pacific. We are impacted on what goes on globally. And when you look at what's going on at the moment, my goodness, I cannot remember a period in my life where we've had this disruption, you know, with what Trump doing, stirring everything up. It'll all settle down. It does have an impact. It will have an impact here. I'm going to go 3% and a box of decent red.
And a box of decent red on the line.
Back it up.
All right. What about you, David? What do you think the official cash rate will be at the end of 2025?
I would go that we're going to be down around the 2.5, purely with so much turmoil going on that, you know, the whole outlook on the world changes almost daily at the moment, because there's so much bloody stuff going on and stupid comments being made left, right, and centre. We put some tariffs on, we take some tariffs off. Geez, I'd hate to be in that tariff office because you wouldn't know what you're going to find the next day. But I think that all of this turmoil is just going to drive things down. We're going to head into a fairly decent recession.
Yeah. Justifying the need to drop even further, right? Yeah. All right, guys. Well, I want to thank you both for chatting to me today around this. I think it's a really important topic, and I know it might be a little bit technical and like, why is this relevant? Well, I think it's really relevant because anything that can improve the levels of wealth in everyday people is something that we should be defending, like
100%.
viciously.
100%.
And I genuinely think that there's been things that have inadvertently occurred which has gotten in the way of that. And so my goal in having this conversation was kind of lift the veil a little bit, and hopefully, better things happen from here. So
Absolutely.
thank you for the work that you guys are doing, and we'll catch you in the next one.
Okay.